Hello, I'm Ruth Chapman. I'm Tax Director at Prime Chartered Accountants. We've been looking at our budget update. We've run 2 seminars and this is my speedy update here. Income tax. In terms of income tax, affects everybody. Personal allowance will increase to £9,440 from April and to £10,000 from April 2014. Again, higher rate taxpayers will not benefit. There's a movement in the thresholds to make sure that that additional personal allowance doesn't benefit anybody who's a higher rate taxpayer. The additional rate of income tax will reduce from 50% to 45%, which is a positive move from the 6th of April 2013, and the trust rate also reduces from 50% to 45%. Other points to note in respect of income tax: taxation of child benefit. This came in from January of this year. If you are in receipt of child benefit and earn over £50,000, your child benefit will be reduced proportionately. If you earn over £60,000, you won't be entitled to it. However, the payment of it won't stop. It's going to be collected through the self-assessment tax return system, and it will bring an additional 500,000 people into the self-assessment tax regime. Statutory residence test, we get that from April of this year, and it's welcome. It's a welcome piece of legislation for people who work in tax and are trying to advise clients on whether they're resident in the UK or not. There are 3 tests effectively. The first checks whether you're automatically overseas. By default, if you don't meet that one, you're automatically UK resident. But if you don't meet those criteria, there's a further test that works out the number of days you spend in the country and combines that with factors like, do you own a home? Have you got business interests here? Have you got family here? Capital gains tax. No changes to the rates. We remain at 18% for basic rate taxpayers, 28% for higher rate taxpayers. The annual exemption increases to £10,900 and £11,000 from April 2014, so a small increase there. Entrepreneurs' relief lifetime limit remains at 10 million. Interestingly, in respect of capital gains tax, entrepreneurs' relief will be available for gains on disposals of EMI shares, and I'll talk about that in a minute. Inheritance tax. No changes. The nil rate band remains at £325,000 for the foreseeable future. This means that on death, an estate is valued, £325,000 is deducted and the balance is taxed at 40%. The 40% can be mitigated by some charitable donations on death, in total down to 36%. Corporation tax. The headline grabbing reduction in the main corporation tax rate to 20% is really good. However, it doesn't come in until April 2015. In the meantime, we moved to 23% from April 2013 and then to 21% from April 2014. The small company rate remains at 20% throughout. What it means is by 2015 there will be no complex marginal rate calculation and all corporate profits will be taxed at 20%. This will give us the lowest tax rate in Europe for corporates. Patent box. This is new from April 2013 and has a corporation tax rate of 10%. It's going to be phased in gradually over a number of years, and it allows innovative companies who either own or license their intellectual property to charge the profits exploited from that intellectual property at a rate of 10%. VAT. No changes to VAT. Sadly, the rate remains at 20%. £2,000 in the registration threshold and £2,000 in the deregistration threshold means that they're now £79,000 and £77,000 respectively from the 6th of April. There's a few interesting bits to talk about. Capital allowances. The annual investment allowance was increased in January of 2013 to £250,000. However, it was reduced from £100,000 to £25,000 last April. There's a temporary increase to £250,000 for a 2-year period. And what this means is that every business should have at least one accounting period falling within that 2-year period at which they can take advantage of a £250,000 investment allowance where they'll get 100% tax relief on those items. However, there's a point to watch here, because unless you've got a December year end, you're not going to get your entitlement to the full 250 in your year coming in or year going out. National insurance. The rates remain the same. We're still at 13.8% for employers NIC and 12% for employees. The big headline grabbing good news that we heard this week was this new employment allowance. Businesses, charities and community sports clubs will all benefit from an entitlement to £2,000 a year towards their employer's NIC bill. This will come in from April 2014. What it means is that a company can employ somebody on a salary of £22,400 a year and they will not have an employer's liability. The equivalent of that is 4 people on national minimum wage, equally no employer costs. Employee share ownership got a lot of headline this week in the budget and a lot of time and a lot of really good detail associated with it. This is the provisions that have come out of the party conference where they highlighted the shares for rights, where you could have shares in your employer company in exchange for giving up some of your employment rights. The initial views on this were mixed. However, when we've seen the detail this week in the Treasury documents, it looks particularly good. Income tax and national insurance will not be chargeable on the first £2,000 of the share value received. Capital gains tax exempt on the gains on disposals of the shareholder shares up to a value of £50,000 at acquisition, and a new capital gains tax relief on the sale of a controlling interest into an employee ownership structure, so could be used as a really good succession planning tool. The Treasury document said that this was expected from the 1st of September 2013, but we realised that later on the 20th of March, on Budget Day, actually the House of Lords voted on this, and they voted against Clause 27 of the Growth and Infrastructure Bill, which is the clause that brings this concept of employee shareholders into force. And it was defeated in the House of Lords. So the bill will now return to the House of Commons, where the government will either accept the defeat and it won't appear at all in our legislation, or they'll try to reintroduce it in a different format. I don't know at this stage why it was defeated, but suspect it's something to do with the giving up of your employee rights in order to take part in this. Enterprise management incentives, therefore, become the most attractive from a tax point of view way of awarding your shares to employees. There's a £250,000 employee limit on the value of the shares available at the grant of the option. And the new news for this year is that entrepreneurs' relief will be available going forward for those people who exercise their options and into their shares before they dispose of them. The 12-month holding period will go out of the window. Enterprise investment schemes and seed enterprise investment schemes saw a lot of press last year. The simplification of the rules that we had last year have meant that a lot of clients with investment funds have chosen to invest in EIS shares in order to take advantage of the capital gains tax deferral and 30% income tax relief that they can obtain. The maximum amount anybody can invest via EIS is £1 million in each tax year. The seed EIS was for new startups, much higher risk, has a maximum of £100,000 annual investment by an individual. The rate of the seed EIS income tax relief is 50% though, so better than the 30% with the main EIS. And for 2012-13 tax year meant that any gain that you'd made that you then reinvested into seed EIS investment was completely obliterated. What's happening for next year is that any gain accruing in 2013-14 that's reinvested in 2013-14 or 14-15 into a seed scheme will qualify for 50% relief. So 50% will be ignored and 50% will be deferred to a future point in time. The construction industry and anybody associated with the construction industry saw some very positive news with the new Help to Buy scheme. 2 schemes associated within this plan. From April 2013 for 3 years, there's the equity loan scheme, and this is for new build houses only, but not first-time buyers only. So anybody taking part in a purchase of a new build may be entitled to 20% of the cost of that property, up to a total of £600,000 as an equity loan, and it'll be interest-free for 5 years. It's repayable when the property is then sold. The alternative is a mortgage guarantee, and this comes in from January 2014 and will last for 3 years. The mortgage guarantee is for people who have incomes to support the repayment of a mortgage but don't have substantial amounts for a deposit. This is where the government will partially fund that deposit. The only other comment that I wish to make is inevitably in relation to tax avoidance and evasion. An interesting part of the budget for me. The General Anti-Abuse Rule, known as GAR, will come in this year. It was expected in April. It's been put back to the Finance Act, so likely to have it. It's part of the Finance Bill and we're likely to have it probably midsummer. Offshore employment intermediaries are going to be looked at. These are effectively the Jimmy Carr and K2 planning that was attacked by the media last summer. The Revenue are going to look at those closely, understand how they work, with a view to legislating against them in 2014. There's also a comment that they're looking at the removal of presumption of employment for LLP partners, which will be concerned for people with LLP structures. And what the Revenue don't like here is where they believe people are artificially manipulating how much profits are chargeable to income tax and how much to corporate tax, where you have both an individual member and a corporate member of the LLP. On first view, it was a bit of a boring budget. But actually, pouring through the Treasury documents, there were some very interesting things for SME businesses. So if anybody wants to talk to us about them, we'd be more than welcome to discuss them further.